Hi everyone, very good evening and welcome back to CrackGradeB. So today we'll be doing the last session on that means the last lecture on the topic of sources of finance. Over here we have discussed all the traditional modes of financing earlier as well, right? Right now we'll be doing the alternate sources of finance which are existing. Okay. Alternate financing sources, there are a lot. For example, the crowdfunding we have. For the example, we have peer-to-peer lending, right? So why they have emerged? Because there has been what you can say, introduction of technology in the financial sector, and that is why we have a concept of that is specifically catered as fintech, right? So with that particular requirement, we are going to start talking about it. The first in question that we have is crowdfunding. Okay? In case of crowdfunding, what we talk about is that it is called as project funding, where what you are doing, you are raising small amounts from a large number of people. Many times on YouTube, when you are surfing YouTube, you might have seen that there are various kinds of ads that come that for the medical relief, or for example for a specific, very specific purpose, they ask the funding, right? So this is what crowdfunding talks about, where they intend to take the money from the crowd in question, crowd in general, right? So the medium on which such amounts are collected, it is internet. That's what, with the advent of internet, it has become easier to access more and more people and to what you can say, gain the funding from them. The crowdfunding is an alternative source of finance which is different from the traditional means like the debt funding or equity funding. Earlier, crowdfunding used to be through mail subscriptions as well, but right now it is mostly done through the use of internet, right? Now, what are the major elements of your crowdfunding? Number one, there is a project initiator, that entity that proposes the idea. Then we have individuals or group who support the idea. Finally, we have the platform that brings the party together in to launch, right? For example, Milap, right? That is something which is a very apt example of crowdfunding. They recently there was an ad that they were collecting funds for the donkeys who are in Gujarat, right? So there are a lot of funds, a lot of factors for which the crowdfunding can be sourced for, not just only for the donation purposes, but also for the other purposes as well. For example, the investment and the kind of thing. You can get the crowdfunding sources with you. So the platform there is a platform which brings the parties together. Next, we have crowdfunding has also been used to fund a wide range of projects like artistic, creative, medical expenses, travel, community-oriented projects, and the list goes on further. It can be used by both profit as well as the non-profit organization. What are the financial benefits that we have? First of all, you will have the access to low-cost capital. Creators can find funders from around the world, so you do not have a limitation for the kind of people or the kind of people that you want to seek donation from, right? So over here you don't have any limitation that how many people you can reach for if you have got a noble cause and if you have got a good cause in which people might be interested. So the world is the limit for you, right? Next is obtain early feedback onto the product. That is also something which is very, very important because you have got a diverse investor range, diverse customer range. So obviously feedback would be diverse as well and for your development. Next is what are the cost benefits for the investor? Obviously cost reduction. Imagine you are investing through a stock exchange and imagine you are giving the investment for this crowdfunding related thing, right? So in comparison, if you talk about the cost of funding over here is very, very less. Then we have neglected sectors. They are focused over here. So crowdfunding doesn't make sense in every industry, but for some like the retail industry or the consumer industry, it does, because retail industry and consumer industry will run onto the wide customer base. So if you have got wide customer base, wide support base, that is how you can perform, right? So not in every kind of area it will be functional, but yes, in some areas it is going to do the wonders. Next, we have increased value to the investors. Let's talk about this. So another reason why crowdfunding is attractive, because it adds value to the company. They act as brand advocates and it can be even used as a focus group. So there is a thing called as word of mouth, right? So that is something which can be useful for you over here, which can be useful for the entity over here, right? There would be a kind of free promotional thing that comes with the crowdfunding. Now, risks for the investor: before you are investing, you have to do the due diligence. You cannot get stuck with any kind of enterprise just like that, right? So due diligence is very important on your behalf. Failure of project execution: if the project fails to get executed in early stage, the whole investment is going to be washed away, right? So one thing first is, like, if I am going to invest in a project, I am going to see that, is this project viable, right? What is the gestation period? In how much time period I am going to get back my investment, right? So all these things you have to see. And the next thing is, after doing the initial verification, there is something called as execution. You have made the plan. Plan sounds great, but it is not going to be great until and unless you are not implementing it well enough, right? So that well enough execution comes only and only if the project implementers are having the good qualification, they are having good expertise and all of that, right? So failure of project execution, that is also something which brings risk in the crowdfunding. Then we have frauds, obviously. Technology is there. Technology is sometimes good, sometimes not that good as well. Next we have peer-to-peer lending. Let's talk about this. Over here, again, it is a platform, right? But the platform is not asking for the funds over here. Platform is doing a kind of matches, right? So they are matching the lenders with the borrowers, those who are in the need of funds and those who want to give the funds, right? Now next we have P2P lending. It is a form of crowdfunding which is used to raise loans which are paid back with the interest. It can be defined as the use of an online platform that matches lenders with the borrowers. See, what happens is, crowdfunding is something which is a source of finance. Okay? It depends. Now, whenever we in India, we have the taxes, we have got corporation taxes, we have got the income taxes. So these are the taxes which will be applicable, right? It will be very peculiar to the platform if they are going to charge any kind of charges, etc., right? But apart from that, for the taxation system we have, you are an entity, you are seeking the finance. What is the use for which you are putting the finance on, right? And what is the profit that you are earning on, and that is the tax you need to pay on. ठीक है, आपको उस पे टैक्स पे करना पड़ेगा. I hope it's clear. Okay, because see, taxation is something which is imposed on your income. You are seeking the finance. अगर आप equity raise कर रहे हो, आप debt raise कर रहे हो, तो there is no point of taxation over there. Platform fees can be there, but not apart from that. Let's talk about this. P2P lending is a form of crowdfunding used to raise loans which are paid back with an interest, right? So why we are talking about this? Because it is used to raise loans. It can be defined as a use of an online platform that does the matches between the lenders with the borrowers in order to provide the unsecured loans. So key pointers, please notice, the borrowers can either be an individual or a legal person which is requiring the loan. Interest rate may be set by the platform or it can be decided by the mutual agreement between the borrower and the lender. Fees are paid to the platform by both the lender as well as the borrower. Because over here, borrower is also getting a service and over here, lender is also getting to use their fund, right? They are also making an investment through which they are going to earn. So both the parties, the lender and the borrower, they are going to pay the fees. Unko fees pay karni padegi. The borrowers pay an origination fee, that is either a flat rate fee or as a percentage of loan amount raised. According to the risk category, and the lenders, depending on the terms of the platform, they have to pay an administration fee and an additional fee if they choose to use any kind of additional service which the platform may provide. Platform is acting as a mediator and platform will decide that what kind of the charges they are going to charge from their lenders as well as the borrowers. It is up to them. Okay. The platform provides the services of collecting loan repayments, acts as a mediator, so have to function all the things accordingly. Doing preliminary assessment on the borrower's creditworthiness, the fees go towards the cost of these services as well as the general business cost. Platforms do the credit scoring, make a profit from the arrangement fee or not from the spread between the lending and deposit rate. Now, why this is the thing over here? Because this is what makes a difference between a bank and the P2P platform. Okay? P2P platform is something else. We have banks who are doing the function of taking the deposits from the customer base and then giving that deposit as a loan, right? So the interest rate which is given on the deposits and the interest rate that they charge on the loan, there is a spread in between, ठीक है? बीच में जो है आपका difference वो बैंक की income है, and this is not the case with the P2P platforms. P2P platforms, they cannot earn through the spread. They can only earn by what you can say charging their platform related fees. That needs to be upfront. They have to tell that, okay, this is the platform fee which we are intending to charge. Okay. Okay. Next is, so yes, in the case of normal financial intermediation, while the crowdfunding, equity, debt based and the fund based, it is going to fall under the SEBI, and P2P lending, it is going to fall under the domain of RBI, right? Next is few RBI guidelines related to P2P lending, right? Not very important for you, but yes, have to go through out of this like once, right? So the RBI, through a notification that P2P platforms, companies that provide loan facilitation from their platform, they will be treated as an NBFC, right? Non-banking financial companies, because ultimately they are dealing with finance. ठीक है, फाइनेंस के साथ डील कर रहे हैं, बट दे आर नॉट एक्टिंग एज अ बैंक. सो नॉन बैंकिंग फाइनेंशियल कंपनीज, no NBFC shall commence until and unless they are getting a certificate of registration from the RBI. So in order to act as a peer-to-peer lending platform and you have been designated as an NBFC, this is a requirement that you have to get the certificate of registration from the RBI. Every company seeking registration with the bank, that is the RBI, shall have a net own funds of not less than rupees 20 million or such higher amounts as the bank may specify, right? When we say net own funds, we talk about the equity, we talk about the preferential capital, right? We talk about the reserves. So this is something we talk about when we say the net own funds, and out of this, investments that you have made in the subsidiaries or your group companies should be deducted. तो जब हम net own funds की बात कर रहे हैं, that talks about preference, equity, your reserves, and then you have to deduct out of it your investments that you have made in your group companies or the subsidiaries. That is something that you have to remove. Next we have scope of activities. Let's talk about it. So an NBFC P2P shall act as an intermediary providing an online marketplace. Okay, we understand that. They are not going to raise deposits. That is not allowed because they have to act as a match platform, right? That is matching lenders with the borrowers. जो lender को borrower से match कर रहे हैं. Not lend on its own, not provide or arrange any credit enhancement or credit guarantee, they cannot do it. Not facilitate or permit any secured lending linked to its platform because they haven't designed to give unsecured lending. See, we have a very huge economy and we have got a lot of gaps. Commercial banks, they are not able to fulfill that particular gap up, and that is why we have different kinds of institutions who are coming up and who are filling this particular gap up, right? जो इस gap को fill up कर रहे हैं. So not hold on its own balance sheet funds received from lenders or funds received from borrowers for servicing loan. Not cross sell any product except for loan specific insurance products. You can do the matches of the loan, and apart from that what you can offer is loan related insurance product, not anything else, right? This is the limit that you have. So understanding the negative list is very, very important. International flow of funds is not permitted. Now this is something which is very factual, so I'll be going quickly through it. Ensuring adherence to legal requirements applicable to the applicants. Store and process all the data related to activities because that can be handy later on. Prudential norms are what? Prudential norms means you are operating as a financial company and you will be having a lot of risk. For example, you will be having credit risk, you will be facing liquidity risk. So what you should be doing in order to prevent that, right? Or what should be your safeguard mechanisms in order to come out of it? So NBFC P2P shall maintain a leverage ratio not exceeding 2. Aggregate exposure of lender to all the borrowers at any point of time across P2P shall be subject to a cap of 50 lakhs. So why these caps are there? So that you do not overexert yourself. ठीक है? The lender investing more than 10 lakh across P2P platform, all the P2P platforms, if you are one lender and you are investing across P2P platforms, then they shall produce a certificate to platforms from a practicing chartered accountant that certifying minimum net worth of 50 lakhs. आप 10 लाख दे रहे हो, then what is your net worth, right? What is a proof of your net worth? So that is also something which is very, very required. The aggregate loans taken by the borrowers. Now this is the limit at the borrower. Aggregate loans taken by the borrower across all the platforms shall be subject to a cap of 10 lakh rupees. That is the limit. The exposure of single lender to the same borrower. Now this is one-to-one limit. One lender giving the loan to the same borrower. It shall not exceed 50,000. The maturity of the loans shall not exceed 36 months. And P2P shall obtain a certificate from the borrower or lender that the limits prescribed above are being adhered to. Right? So once you have given the clarification, you have given the justification, you are producing a certificate, you are legally bound to what you can say follow that, right? And if you're someone who's not following it, there are obviously repercussions of that. Now next thing we have bootstrapping. Now a kind of innovative term, right? Now individual is said to be bootstrapping when he or she attempts to found and build a company from personal finances or from the operating revenues of the new company. So what are your sources of finance? These are your sources of finance. Either you are starting something with your own finances or you are taking the revenues, like whatever you are earning, you are just redeploying that particular funds again into the company. Common mistake made by most the founder is they make unnecessary expenses towards marketing, offices, equipment that they cannot really afford. So it is true that more money at the inception of a business leads to complacency and wasteful expenditure. On the other hand, investment by the startups from their own savings leads to cautious approach. It curbs wasteful expenditure, enables the promoter to be on their toes all the time. So this is a general rule. Suppose if I have 10,000 rupees from my friends, right? I'll be like, okay, fine. I have received this particular money as a gift, and I am going to utilize it in whatever way I like it, right? But when there is an amount which you have earned, right? You are very cautious about it, that how you should be using it. Right, so the same thing is being told over here, that in your business, when you invest your own money, your own hard-earned money, you decide onto the every matter very cautiously, that where we should be investing in and whether we should invest a lot onto the marketing or not. If you are someone who's watching these investment related programs, like for example Shark Tank India, you will get to know that there are certain businesses which do spend a lot unnecessarily and then they get bashed for it. So here are some of the methods in which startups firm can bootstrap. Now let's talk about this. So the credit extended in connection with a good purchase for resale by a retailer or for a, just wait for a second. Number one, we have trade credit. Now, trade credit is also a source of finance for us. Collateral is something that they cannot do with, right? So, it is always unsecured thing. Okay. We have trade credits. So, for example, suppose I have purchased material from someone, right? And instead of making instant payment, if I say that I will pay you after 40 days. So now for that particular period of 40 days, I can utilize it. I can utilize the same amount of funds for something else, right? So this is how the trade credit can be turned out. They can also turn out in a good source of finance for you. So credit extended in connection with the goods purchased for resale by a retailer or for raw material used by a manufacturer in producing its product is called as the trade credit. Trade credit may be defined as credit available in connection with the goods and services. For example, fixed assets may be purchased on credit, right? So, whenever we say trade credit, we mean to say that the goods that we buy in order to resale in our business. For example, I have a business of manufacturing this particular pen. So I have to buy machinery and I have to buy raw material. So trade credit is the term which is used in relation to raw material, not in relation to the machinery. Machinery के relationship में नहीं use किया जाता because that is a fixed asset, right? And we do not use the term trade credit for it. We use the word trade credit for the kind of raw material and the other things that we use in our business, and if you purchase it on credit, right? So that gives us a time for repay the amount. During this period, before the payment becomes due, the purchaser has a debt outstanding to the supplier. So next is this was the factoring. Now next thing we have factoring, right? Factoring is something. It is also, you can understand it as debtor management. Suppose I have sold my goods on credit, right? Now I have to recover the payment from my debtors. So I can outsource this activity to a third party. ठीक है, मैं इस activity को एक third party को outsource कर सकती हूँ. That party is going to do all the debtor management on behalf of me. मेरे behalf पे जो है वो सारा debtor management करेंगे. So over here, factoring typically works well for the small and medium segment companies in their growth phase where the risk appetite is very limited, right? So what do we want? That there should be a good efficient debtor management so that we can recover whatever amount of goods we have given on credit. अगर हम उसको अच्छे से recover कर पा रहे हैं तो the clear benefit that is over here is that the cash raised is directly proportional to the underlying sales and is hence largely scalable unlike any traditional bank finance. So I can tell to my factor that see, I have made the sales of 10 lakh rupees. Now take this invoice, recover it, right? And meanwhile, give me the funds on behalf of this invoice. If you are someone who's into preparation of this particular exam, you already might be knowing about the TREADS system that has been developed for the MSMEs so that they can get financing of their invoice done, so that they should not fall short of the working capital. वो working capital में उनका shortfall नहीं होगा, right? So this was the factoring. The seller makes the sale of goods, generates the invoice. Now this is the process. Sale of goods has been done, invoices have been generated. The seller then sells all the invoices to a third party called the factor. Factor pays the seller after deducting some discount, right? So if the 10 lakh rupees is what the worth of my invoice, the factor is going to deduct 2 lakh and he is going to give me the remaining 8 lakh rupees, right? So the rate of discount in factoring varies. Different kinds of factor. Again, NBFC organizations, they are also someone who is going to open a factor organization. So NBFC factor, we have a separate organization for that, right? Factor does not make the payment of all the invoices immediately. Rather, it pays only up to 75 to 80% of your invoice value. ठीक है, सारा पेमेंट आपको नहीं करेंगे, only 75 to 80% is something that will be paid to you. A factoring company undertakes transaction based on the quality of the receivables, unlike a bank which takes the credit decision based on the financial history, cash flow as the collateral. Factoring company sees that to whom you have sold the goods, right? If you have sold the goods to a big corporate, so the quality of receivable is good, right? If that particular person has been consistent in making the payments, then the quality of receivable is good. Now this was the factoring. Now lastly we have the lease financing, right? So what happens in lease is there is an asset in question, right? That asset is given on rental. ठीक है, आप ऐसे समझ सकते हैं that asset is given on rental. If that asset has been given to the other party, that the other party can use it for a substantial period of time that covers entire duration of the life of the asset, right? And then at the end of the contract, that asset will go to the party whosoever is using it. That is called as finance lease, right? But when suppose I have an aircraft and we give it on lease, so the time period for which the aircraft is there, the life of the aircraft is 20 years. And I have given that aircraft on lease to one party for 5 years, to other party for 5 years, and then to a third party for 5 years. So what I am doing is I am doing operating lease. दिस इज अ काइंड ऑफ प्योर रेंटल, ठीक है, ये एकदम प्योर रेंटल की तरह है. सो these are the two kinds of leases that we'll be talking about. So lease financing, one of the most important sources of medium and long term financing, where the owner of the asset gives another person right to use that asset against periodical payments. The owner of the asset is known as lessor and the user is called as lessee. Okay, the periodical payments made by the lessee to the lessor is known as lease rental. Under lease financing, lessee is given the right to use the asset, but ownership lies with the lessor, and at the end of the lease contract, the asset is returned to the lessor, or an option is given to the lessee either to purchase or to renew the lease agreement. आपके पास option होता है, but in different kinds of lease, different kinds of options are there. Let's talk about it. This is a very generic definition, but we will have a proper picture in case of finance and operating lease. Let's talk about it. So in case of finance lease, it is the lease where the lessor transfers substantially all the risk and rewards of ownership to the lessee. That means this is a kind of lease. Imagine I do not have money to buy an asset. So there is another person who has bought the asset on my behalf and it has given me on lease, right? He is charging from me the amount that includes the principal portion as well as the interest portion, right? And at the end of this contract, that asset is going to be with me. So this is called as finance lease. Okay, finance lease has two phases. The first is called as primary period. Over here it is non-cancelable. You cannot cancel the lease contract, right? In this period, lessor recovers the total investment. So if the other person has financed my asset, he is going to recover his whatever amount he has invested in it, right? And after that, there is a secondary period in which the lease rentals are very low because already a substantial amount of lease rentals has been recovered. ठीक है, बहुत ज़्यादा जो amount है वो already recover किया जा चुका है. Then we have operating lease. Operating lease is something very similar to rent. Okay. So here risk and rewards, they are not transferred, which are related to ownership. The term of such lease is much less than the economic life of asset. If my asset's life is 20 years, then I have given the lease or asset on lease to one party for 5 years or for 6 years, right? So that does not cover the entire life of the asset. That does not cover it. Next, we have venture capital funds. So venture capital fund is a segment which takes the money from the investor and then invests in new budding enterprises, right? It could be startup. They can also provide the fund to an existing enterprise which is having the growth related potential. So it is an investment fund. It takes money from different investors, right? And then provide the capital in startup, small, medium-sized enterprise. At least 75% of the investable funds shall be invested in unlisted equity shares, right? So whatever funds you have, 75% of that should be invested in equity. Okay, आपको equity में invest करना है because you are giving the funds to the enterprises as an owner. You want them to grow. You are taking the risks. Okay. Next, the main features of ventures can be summarized. High degree of risk over here. Why? Because you are purchasing equity shares and obviously there is a high amount of risk. Equity participation. Venture capital financing is invariably an actual or potential equity participation wherein the object of venture capital is to make the capital gain. Long-term investment. Venture capital financing is a long-term investment. It is generally taken long period to encash the investment. See, obviously you are investing in the equity. You are not going to encash the investment very soon. No, because when you invest as an owner, there is a phase that you need to see. आपको एक phase देखना पड़ेगा where you have invested the amount and now you are reaping the benefits out of it. ठीक है, जब आप उसका benefit ले रहे हो, so there is a transition phase that you need to go through and it involves a lot of risk. When you have invested as an owner, so obviously you are going to take a huge interest in managing the enterprise, right? So venture capital funds, they are having an active interest in the management of the enterprise, right? Venture capital, it combines the qualities of banker, stock market investor and the entrepreneur in one. They are providing you the finance, ठीक है, वो आपको finance भी provide कर रहे हैं. They are acting as an entrepreneur as well, because they are helping you to take the business decisions. They are helping you form a contact, right? So all these kind of things they are provided. Okay. Next is stages of financing. So initially, seed capital. Seed capital means very small amount of finance which is provided for a new idea. Then we have startups. So when a new business is launched, when a new idea is launched, at this stage entrepreneur and his products are yet untried, and finance which is usually required fall short of the owner funds. So that is why startups also need such kind of financing. Then we have second round of financing. It refers to the stage when product has already been launched in the market but not has earned enough profit to attract the new investors, because we need a certain amount of time for the product to be profitable, right? Not every product as and when it is launched gains the popularity. No, it needs a substantial amount of time to get the hold of customer interest. Okay. Third round financing is for the growth related companies, and then we have bridge financing. So this is the last financing round before the IPO is launched. Okay. तो उससे पहले, just wait for a second. And lastly, we have buyouts. So that means transferring the management control by creating a separate business. Okay. It can be of two types: management buyout, management buy-in. So venture capital institutions, they provide funds to enable the current operating management to acquire an existing product line. Okay. Enable. They represent an important part of the activities. So over here, they are enabling the management by giving them the funds that you can acquire an existing product line or you can expand your business. Management buy-ins, these are the funds provided to enable outside group of managers to buy an existing company. That means you are giving the funds to the outsiders that they can buy the existing company. Management team, there are three parties. Management team, the interested people who are trying to buy a company, then you have the target company which you are seeking to acquire, and then you are having the investor, that is the venture capital institution which is investing the money. MBIs are more risky than the MBOs and hence are less popular because it is difficult for the new management to access the actual potential of target company. Now suppose we are already running a food related company and now we are eyeing that there is a competitor that is making juices and we want to acquire it. We can, because we already have an expertise. But what about, suppose we are having a tire related company and then there is another management who is interested. There are certain group of people who are interested in buying my company, but they might not be having the skill set which is required to take this business forward, right? So that is why buy-ins are risky. And then we have angel investors. So they make small volume of investment in new entities and the money which they have belongs to their own. For example, venture capital fund, it takes the money from investors. Angel investors are the ones who invest their own money. Angel funds, subcategory under the category 1 venture capital funds, this is called as angel funds, and such kind of funds, they take the funding from the angel investors, right? There are limits who can be called as an angel investor, right? But that is not something which we will be reading over here. So this is it. We have completed the sources of finance. I hope you must have understood the video. If you did, then please do not forget to like this video. Thank you so much for joining in. Good night, everyone.